When it comes to building wealth in the stock market, investors often find themselves choosing between two powerful strategies: value investing and growth investing. Value investors hunt for bargains, stocks trading below their intrinsic worth, while growth investors chase companies with the potential to expand rapidly. But which approach delivers better returns? In this segment, we'll break down the core differences, examine historical performance, and help you decide which style best fits your financial goals. Today we will talk about value versus growth investing. Which one wins? So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the basics, definitions, and core philosophies. The debate between value and growth investing has defined the investment landscape for decades. At its core, the distinction lies in the criteria used to select stocks. Value investing focuses on buying companies that appear to be undervalued relative to their intrinsic worth. These stocks typically have low price-to-earnings (P/E) and price-to-book (P/B) ratios, high dividend yields, and stable cash flows. The assumption is that the market has temporarily mispriced the stock due to overreaction, sentiment shifts, or cyclical downturns. Conversely, growth investing seeks out companies with strong future potential, often at the expense of current profitability. Growth stocks generally have high valuation multiples, low or no dividend payouts, and rapid revenue or earnings growth. Investors believe the company's future performance will justify its current premium. These companies are often in emerging industries such as technology, biotechnology, and e-commerce. 2. Historical roots and key figures in value and growth investing. The origins of value investing trace back to the 1930s with Benjamin Graham and David Dodd, whose book Security Analysis laid the groundwork for identifying undervalued securities through rigorous fundamental analysis. Warren Buffett later popularized the strategy, emphasizing buying wonderful companies at a fair price, rather than just fair companies at a wonderful price. Value investing hinges on concepts like margin of safety, intrinsic value, and long-term patience. Growth investing, on the other hand, became more prominent in the mid to late 20th century, especially with the rise of tech companies. Legendary investors like Peter Lynch, who managed the Fidelity Magellan Fund, championed a more flexible approach that blended growth with fundamental analysis. Today, investors like Cathie Wood of ARK Invest represent a modern breed of aggressive growth investors who focus on innovation-driven companies, sometimes even before profitability is reached. 3. Metrics and analytical tools. How value and growth investors evaluate stocks. Each investing style relies on different tools and metrics. Value investors typically screen for low valuation ratios, such as P/E, P/B, and EV/EBITDA. They assess a company's balance sheet strength, free cash flow, and dividend sustainability. The goal is to find businesses priced below their intrinsic value, based on discounted cash flow models or net asset values. These investors often look in out-of-favor sectors like financials, energy, or industrials. In contrast, growth investors focus on metrics like revenue growth rate, future earnings projections, return on equity, ROE, and total addressable market, TAM. Technical indicators and innovation potential also play a role. Many growth stocks are found in fast-growing sectors like cloud computing, artificial intelligence, renewable energy, and biotech. Growth investors often tolerate higher volatility and valuation multiples, provided the growth trajectory remains strong. 4. Performance across economic cycles, when value or growth takes the lead. Market cycles have a significant impact on which strategy outperforms. Historically, value investing has done well during recovery phases and periods of rising interest rates. Companies in value sectors tend to generate strong cash flow and benefit from economic normalization. Value also tends to outperform in high inflation environments, where future earnings, critical to growth stocks, are discounted more heavily. On the flip side, growth investing thrives in low interest rate environments, when borrowing is cheap and future earnings are valued more highly. The 2010s were a golden era for growth stocks, fueled by ultra-low interest rates, digital transformation, and investor appetite for innovation. However, from 2022 onward, rising inflation and rate hikes by central banks triggered a rotation back to value. This cyclical nature means neither strategy dominates forever, and understanding macroeconomic conditions is critical for choosing the right approach. 5. Risk factors and volatility. Understanding the trade-offs. Both strategies carry unique risks. Value investing risks include the possibility of falling into a value trap, where a stock is cheap for a reason, such as structural decline, poor management, or disruptive competition. Investors may overestimate the company's recovery potential or underestimate changes in the business model. Growth investing risks are centered around overvaluation, hype, and volatility. High-growth companies are particularly sensitive to earnings disappointments, negative news, or changing market sentiment. When expectations are sky-high, even a small miss can lead to a sharp correction. Growth stocks also tend to be more correlated with speculative bubbles. Think the dot-com crash of 2000 or the tech sell-off in 2022. Investors must balance the potential for outperformance with the risk of large drawdowns, and portfolio diversification becomes essential to managing these exposures. 6. Real-world examples and sector tendencies. A deeper look at specific companies and sectors helps illustrate these investing styles. Value stocks are often found in mature, cyclical industries. Think JP Chase, ExxonMobil, or General Motors. These companies may not be growing quickly, but they generate steady income and often pay dividends. They're particularly attractive to income-focused investors and those looking for lower volatility. In contrast, growth stocks include names like Nvidia, Amazon, or Tesla, companies that have seen exponential growth due to their role in transformative technologies or market disruption. These firms typically reinvest profits into expansion and may only become profitable after several years. Sector-wise, value investing is often associated with financials, utilities, and manufacturing, while growth is synonymous with technology, healthcare innovation, and consumer discretionary. 7. Combining strategies. The rise of blended portfolios and factor investing. Recognizing the strengths and weaknesses of both strategies, many investors now adopt a blended approach. Balanced portfolios may include a mix of value and growth stocks, either through individual stock selection or through ETFs and mutual funds. Popular funds such as Vanguard Growth ETF, VUG, and Vanguard Value ETF, VVE, allow investors to tilt their portfolios according to market conditions. Moreover, factor investing, which targets specific attributes like value, momentum, quality, and size, has emerged as a modern framework. Smart beta ETFs use these factors to construct portfolios with desired risk-return profiles. Lifecycle investing strategies, such as target date funds, automatically shift from growth to value orientation as an investor nears retirement. This underscores the view that both styles have a role to play, depending on an investor's time horizon, risk appetite, and financial objectives. 8. Final verdict. Which one wins? And why? It's the wrong question. So, which one truly wins? Value or growth investing? The answer, while unsatisfying to some, is it depends. Over the long term, studies by Fama and French and other researchers have shown that value stocks have historically outperformed growth stocks on average, especially when adjusting for risk. However, the magnitude and consistency of that outperformance have fluctuated over time. During some decades, growth stocks have taken the lead, especially during technology booms or periods of monetary easing. Rather than viewing this as a binary contest, investors should recognize that both strategies offer distinct advantages under different market conditions. The real edge lies in understanding when each style is likely to outperform, maintaining proper diversification, and aligning investments with personal goals and timelines. Successful investors aren't dogmatic. They're adaptive, informed, and patient. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.